Hello, welcome everybody. Glad you can join me, and it's one of my favourite times of the year. I'm a big planner. I love planning. I love setting myself targets every quarter, every month, every year. I even got a 17-year target for this particular project, Strategic Waves. But today I'm going to go through the results of the first year's trading for the Strong Buy portfolio. Some things have gone really well, some things not so well, but we'll go over those and what I'm going to do to put things right. But first of all, it's all about the money, isn't it? So let's go through the money that we've raised this year from the Strong Buy portfolio. On the screen now is the key numbers for the Strong Buy portfolio. So year one's just ended the end of July 2024, started August 1st 2023, and if we just go through these numbers we can see opening balance zero, obviously because it was just starting. I bought a total of $3,381 worth of shares. Now that's the bit that's not gone so well. Cover that in a few moments. I sold shares for $950, so my total cash outlay was $2,431. Those shares were worth, at the end of the period, $3,254, so an $823 profit, giving me a return of 34%, well above the S&P return of 14%. That's my marker, that's what I measure myself against, but I beat it by more than twice, so that's just great. Really pleased with that. And once compounding starts to take effect, this thing's going to go really well. Now, second year's already begun because it's what now, the 11th of August. So the starting point was exactly the same. Obviously the final value for the year one becomes the opening value for year two. So far I've bought $244 worth of shares. You might remember that this portfolio was set up to buy about $250 with every investment, and so I've made one investment, $244. Final value at the moment as of the close of business yesterday was $3,618. Profit 119, so 3% so far this year, well above again. S&P's had a poor month, as we all know, down 2%, but we're well above that, so we're really pleased. Now what I want to look at is the problem. It's this, the amount we're investing, that's not hitting target. So let's just scroll across to this area here. When we set things up, the goal was to buy 2 trades per month, 2 investments a month, but as we can see, nowhere near it. Q3 last year I only made 2 trades. It was supposed to be 6, miles off target, and in fact only once, Q4 last year, did I get anywhere near what I should be at. So what I've done is I've increased the number of articles I'm writing about. Remember, the whole point about this, to give transparency, was to write articles on the Seeking Alpha platform, and when I give them a strong buy rating, that's what I was going to invest in. Last year I was doing 4 articles a month, thinking I might get 50% of those might be strong buys. However, got nowhere near that. I do a lot of research in advance to try and decide which ones I'm going to write articles about, hoping that we'll get plenty of them on target, but it's not worked. So what I've done this year is I've almost doubled the number of articles I'm writing. It's gone from 2 a month to 7 a month, 4 a month to 7 a month rather. We started at 2 a month, but then last year was 4 a month. This year it's going to 7 a month, and that appears to be having the correct input. If we go to the Strong Buy portfolio, which is here, we can see that in July I bought both Aris and Taboola. So that's on target. In August I bought Ulby, but I've already submitted the next Strong Buy article. If you subscribe to my newsletter, you'll already have the note about that saying I've already bought it. But hopefully Monday the next Strong Buy will be published, and then I can put the date in, obviously not the date closed, and I can put the actual price I buy at, because again this average price per share comes from the Seeking Alpha platform. I just do it for transparency, so you can look back on a sort of a separate website to make sure I'm not making all this stuff up. Now the next thing, as well as deciding what to buy, thing I've not got as many as I wanted. The other thing is deciding what to do about these open trades. Now if we scroll across here, we can see that some of these trades are starting to cause me concerns. The two that concerning from a negative viewpoint are Luna, Intuitive Machines, down 34%, and Elva, Electrovia, down 26%. Both of those needs looking at. But the one that's concerned me on a positive side is Bluebird, BLBD, that's up 167%. At some stage I've got to take profit, and the key is, when do you do it? When do you take your profit? When do you take your losses? I do that by tracking. Now let's have a look at the tracking part of this database. So this is the earnings just being released at the moment. We can see Bluebird beat on both, and so I'll look at Bluebird in a moment in some detail, but neither Electrovia, Elva or Luna have yet reported, so I won't make a decision on those till I get it. We can see on the whole though, the companies we're investing in are beating hugely. Really pleased with that. But what I'm going to do next is look at Bluebird, the only one that we've got the information to make a decision on. On the screen now is a PowerPoint I'm building, which I'll go through in my next video, I hope, once all the data's in, once every single quarter report is in from the 12 or 13 companies we have on. I'll go through each one, but I can do Bluebird now because we've got the data in. It's one we're concerned about. So this quarter, Bluebird reported record profits in their history, and they're a well-established company. They're not a newbie, new off the blocks. Margin was up 4 percentage points year on year to a record 14.5%, and the school bus order backlog, which is a crucial thing because that's where the money is, 5,200 units, and they're backed by government money, so we know that's going to turn into revenue. Fantastic situation. They're carrying on with their investments in lean manufacturing, and lean manufacturing is having an impact on a few of the companies we're looking at the moment, and it makes them balance their operations, so they've got the right amount of stock, the right amount of finished goods, the right amount of orders, everything's flowing as it should, and they negotiate with their suppliers and their customers to get the whole thing running as lean as possible. On top of that, they've announced an investment of $160 million on a new manufacturing space. Need to look into that some detail. They've got a big loan coming, not a loan, a big grant coming to help them do that. But I've got to look at where the other money's coming, where they're raising money, and build that into the cash flow properly. But what I have done is I've put some basic figures into my mathematical model, and it delivers a new price target of $97. They're currently at about $48, so that's 100%. So I'm definitely happy in Bluebird. I'm definitely staying in. But I am going to look at the mathematical model to give you some idea of how I generate all of this stuff. Now, this is my mathematical model for Bluebird. At the moment, historically, the revenue, I've just been dealing with the total revenue, but as I get more into this company and make this model more accurate, I'm going to change it so I look at the 4 segments that they report, so parts, alternative fuels, diesel, products and other services, and the revenue will become a total of those 4, and each one forecast independently. And one of the main reasons for doing that is they've got completely different cost of goods sold. The margin for each element is totally different, and although I'm using at the moment I'm just using an average, I'm using an average revenue and an average gross profit. As things get bigger, it's not going to deliver an accurate result. So that's the first change I'm going to make. Now, if we just scroll down on this, you can see how much work there is to do on these models. It just takes hours and hours and hours and hours. But these are the changes. Now, first of all, revenue growth. I had it growing at around 12%, but Q3 it's up to 20%. Cost of goods sold was at 9%, so 10% margin. They got it to 13% margin last year, but now it's up to 20% margin. It's a huge improvement, and I've added that to the model to begin with. Sales and costs are down as a percentage of revenue, but not necessarily as a total figure. At the moment, I put in the percentage of revenue, the new percentage of revenues, but I'm going to look at that one a little bit later. Fixed asset schedule. We know they're building this new building, and so I've increased the capex from 10% to 17%, then 18% and 19% of revenue. I'm not sure about those figures yet. That's something I need to really go through when we get the meat of the data. Probably won't get that till the end of next quarter. The next big issue is the net working capital schedule. This is how much money is in the operation, so the inventory, how much money they're waiting to get back off their customers, how much money they've got to pay out to their suppliers. That's the net working capital, and there's been a big change, a really big change. Things are going better in some areas, worse in others, but let's have a look. Day sales outstanding, so this is their receivable money. It's tripped up from 5 days to 6 days, still outstandingly good. But look at the change in inventory. 3 years ago, the average was 64 days outstanding. It dropped last year to 49, but this quarter it's down to 33. That makes an enormous difference. It really fundamentally alters the amount of cash they're generating. Accounts payable has come down also. That's probably a recognition of how much money they're putting through these suppliers and the fact they're probably having to pay a bit early to get extra cash in, or maybe they've negotiated better terms, so they've got a bit of cash on hand at the moment, so maybe they're using that cash to generate more profit. Down at the bottom here we can see where I'm starting to pull in the revenue for the different segments they discuss. All of this data brings in automatically. I've just put up for I subscribe to Wise Sheets, which means I can get all this data automatically, so I don't have to type in the historical data, but I do have to type in the future data to work it out. Now if we go back up to the top, we can look at the new cash flow forecast. Here's my new cash flow forecast. We can see a dip 2023 to 2024, but that's you know, there's a bit of they pulled a lot of money last year out of the inventory, and they can't pull money out of inventory every year, but otherwise you'd end up with zero inventory, which is not possible. So there's a bit of dip, but then a really good trend. However, let's go to the DCF forecast, the discounted cash flow forecast. Now I use a terminal growth rate of 0.5 and an average discount rate of 8%. I never know what to do about discount rate. People, every time I use a discount rate, in the comment section of the article I get a whole load of negative feedback about what I've done, and so I now produce this little chart. I only added it fairly recently, which you can see, which shows the fair value of these shares at different discount rates, so everybody can kind of look at what discount rate they'd like to use. It's funny how people get more uptight about the discount rate I use than, you know, what it's based on, the forecast for revenue and forecast for costs and forecast for capital expenditure and all of those other things. People get more uptight about that. But anyway, look at that. $97.3 is my current forecast for Bluebird, more than 100% above where we are, so we're going to hold. We look forward to see what happens at the end of the year. Well, that's it for that video. I hope you enjoyed it. I enjoyed making it. I love talking about results and plans and things. It was really good. Hope you enjoyed. If you did, could you boot the like button for me? Really appreciate that. Helps me get the message out to more people, get more followers, which is kind of what the whole thing's about, trying to make a bit of money together. Next video is going to be on those other two companies I discussed, Electrovia and Luna, just to decide if we need to pull out of those or not. But we need those results in to make a decision. Staying long Bluebird. Results are looking great. Looking forward to the second year and reporting to you as that goes along.